Welcome to day 60 of me backtesting my way to success. First trade was a win and a loss, and the reasons why I entered were this 4-hour order block right here, daily fair value gap to the downside right here, and equilibrium from the swing high to the swing low because we're in a downtrend. Once it was inside of the Fibonacci golden area, I entered on a break structure. So on this candle I entered. Take profits were this area of liquidity and this area of liquidity. I was also considering of placing a take profit at like this volume area, but because I kind of combined it with the support level because we had two really good bounces right here. That's why I placed my first take profit this area and not like at the volume area, was because of that. And then once my first take profit got hit, like once this candle was finished and this next one began, out of nowhere, I just got a feeling of like, you might want to place your stop loss to break even. And I was like, I don't know, man. I mean, I can understand why price would take out this area of liquidity because we have two bounces again. And I can understand that, but imagine just the risk-reward ratio of 4 just hitting, and I thought that it was better than price just maybe taking out this area of liquidity than before taking out my stop loss reversing. And yeah, so what I can take from this trade is to trust my gut. When I get that feeling of not entering a trade or moving my stop loss, I should definitely listen to it. And that's probably something you should do too. Once you've gained some, at least, you know, I don't really have much experience, but once you have gained a little experience in the field you're trying to get experience in. So let's just get on with the monthly recap. Okay, so on day 31, I learned to be patient again, and that's also something that you will hear quite often when watching my videos or when watching the recaps, because patience is a huge thing for me right now. And yeah, maybe it's going to change once I blow some funded accounts, because a friend of mine said that that was the same case for him, and once he blew a couple of fundeds, it actually got better. On day 32, I wrote down again to be patient and also to not place too many take profits, because I was placing like 5 or 6, you know, and it's like way too many. I think 1, 2, 3 is enough, or at least right now, that's what I think. On day 33, I wrote down that I should think about every action twice and give my stop loss more breathing room. Okay. On day 34, I wrote down that I should be sure to analyze correctly because because I just got a mistake somewhere because I wasn't concentrating enough, and so you have to pay attention to what you do and to what market does. On day 35, I wrote down to not go against my guts, to think, and that patience is the key. I wrote all of that in caps, which is kind of ironic because it seems that I got impatient with my impatience. And yeah, again, don't go against your gut. That's also the same thing that I learned today. On day 36, I wrote down that I should place a better stop loss, trade with the bias, and don't enter when a stop loss feels awkward. And I should also pay attention to the wick. So basically what a candle tells. On day 37, I wrote down again to be patient and to not enter for a trade when a confluence feels awkward. On day 38, I wrote again to trust my gut, and in brackets, well done. On day 39, I wrote down that I should look at the bias before entering. On day 40, to not enter when liquidity from an order block gets taken out, since it means that price is going even lower or even higher depending on if the order block is like at the high or at the low. And the reason for that is because that is like a minor liquidity and a sign that price is going to go lower. At least that's what I found out for me. Of course, that doesn't happen always, but like at the cases where I traded, it kind of happened quite a bit. On day 41, I wrote down that I shouldn't enter for a trade when I'm under time pressure. Instead, I should just, make an outro and say, I didn't find anything, we'll see you on the next one and so on. And that's what I didn't do on day 41. On day 42, I wrote down that if the liquidity is above or below, depending again, the order block of a value gap gets swept, then the price will continue in its direction. So basically the same thing, but this time it happened for fair value gaps. I remember that because on day 40 it happened for an order block, and on day 42 it happened for a fair value gap. And for some reason I didn't think that that if price takes out the liquidity from an order block, that it's going to go higher. Then that means that if it takes out the liquidity above a fair value gap, that it's going to go higher, which is kind of stupid, to be honest. But yeah, you're still learning. On day 43, I wrote down that I should move my stop loss to the break even when I'm unsure whether my second take profit gets hit. On day 44, I wrote down that I should on day 44, I wrote down that every confluence that gets used, even by just a little bit, is instantly less valid. And for example, if right here there would have been an order block with a value gap, as you can see, price went into it, that means that it already is less valid. On day 45, I wrote down that I should look at every time frame before entering and that patience is the key. Day 46, patience again, and I was overconfident because I won the first trade and it was a really good trade. Then I got cocky and lost the next 2 or 3. On day 47, I wrote down that I should use the fixed range volume profile tool more often because I was just going through the charts without entering for a trade because I was trying out the fixed volume range profile tool, and whenever I did that, price just really reversed at the volume area, and I was like super stunned because I didn't enter, but it made so much sense. On day 48, I wrote down that I should be less greedy, pay attention to the market, and not miss a confluence, which leads back to concentration. 49, again, concentration, and to look at every time frame before entering. So that leads back to patience. Concentration, patience, trusting your gut, and just learning some new technical stuff through market experience were all my mistakes slash things that I should do to improve my trading up till now. Day 50, I wrote down that I should double or even triple check everything before entering because I missed a couple of things again, and yeah, that's why. On day 51, I wrote down that I should give my stop loss more breathing room. On day 52, again, to be patient before entering a trade, take another look at every time frame. Because I was looking at like only a couple of higher time frames, not everyone, and I missed a really high time confluence, or just in the higher time frames there was a different trend than in the lower higher time frames. So in the 1 to 4 hour there was a different trend than in the daily, weekly, and yeah. On day 53, I wrote down that I should give my stop loss again more breathing room. On day 54, that maybe changing the position's color was a good call because usually it is green for the take profit and red for the stop loss area. And I think actually I heard that red is associated with failure and bad, and I was on a huge losing streak for quite a while, I think, before changing the positions colors, and once I changed them, I instantly won. Maybe it's just pure coincidence, but maybe it really had something to do with that. On day 55, I wrote that I should have more confidence and give my stop loss more breathing room again. On day 56, I wrote down that I should enter when price even just barely dips into the Fibonacci golden zone and then breaks structure, and of course lines up with other conferences. Day 57, I should be more patient and have less FOMO. On day 58, I wrote down that I should use my trading common sense. Because, for example, the common sense that, or for me at least, common sense is, for example, after a impulsive up move, what follows? A retracement can be either this big or can be this big, and then it goes higher. On day 59, I wrote down that I should zoom out and look at the bigger picture because, for example, you can see my chart right here. I was looking at this much of the chart, and this part of the chart was saying like, yeah, price is going to go down, is going to go up. But then I zoomed out a bit, and now it made sense for price to go down since it lined up with the golden zone from like a higher perspective. Like for example, if it would have been like right here, it made sense with the golden zone. There was an order block, liquidity sweep. It actually made a lot of sense, but I was just so I didn't zoom out and was just focused at this area. And today I learned that I should listen to my gut. Like I said, like 10 minutes ago. And so that's already it for today's episode. We'll see you in the next one.